Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with me as Sumera Abdi and Pavitra Pari. Good morning, girls. The wait continues for our markets, the global markets. 11:30 p.m. is when the Federal Reserve will announce its interest rate decision. So today's trading session is going to be, we'll pass it by just waiting for that announcement to come through. But when it comes to the markets and the levels that we are seeing, first, the early morning rally fizzled out. The markets dipped, but that dip has been bought into. So from the day's low, we managed to recover close to about 70 points on the Nifty. So it's just flashing red and green on the benchmark indices. The Nifty is mildly lower. The mid-cap index is mildly higher. It looks a little bit like Christmas. But again, you've got to keep the screen, the market levels in context to what's happening across the rest of the Asian markets, where the cuts are pretty deep this morning. So across Asia this morning, you've got cuts of close to about 1.5% on the key indices. And look at India over there. Today, of course, it's flat. But on a year-to-date basis, many of the Asian markets, emerging markets, are showing you cuts of nearly 20%, while Indian markets continue to show resilience and are currently up close to about 2.5%. Talking about the big winners, it's a lot about the FMCG names and the strength that they're showing this morning. Britannia, HUL are the top two Nifty gainers. But apart from that, you've also got Nestle, ITC Higher and Trade, Reliance Industries. That big boy is contributing to the way up as well. Hi.
Hi, good morning. So yeah, Reliance is definitely, a spot of support for the market at a time when all of these cues are a little bit negative. And it has actually, for the past week, it's been a little bit of a drag. So today it's holding up. A few of the pharma names, the likes of Apollo, DRL, some of those will come up on your screen. These ones looking quite good. Sun also holding up. On the downside, it's really some of the PSU stocks today which are not doing so well. So the likes of ONGC, NTPC, and the entire cement pack is seeing some cuts today as well. Of course, this is after a big run up, so there's no discounting that. But the likes of Cement, that is the biggest loser on the Nifty right now. You have India Cements and Ambuja. These are seeing significant cuts, and the banks also seem to be taking a little bit of a breather today. But it is really that big FOMC queue that we're waiting by for, so that is going to be key to track. Tomorrow you have Accenture's earnings and the guidance, of course, so that's something important to watch as well. And then we're checking out what's going on with the crude move, because there has been quite a slip on that overnight. So it is all of these cues that we're tracking, but Sumera, probably resilient would be a good way to describe this market.
All right, so let's get started. We have a lot lined up for you on the show today. The market gives up opening gains. Key indices are trading flat right now. Banks, metals and infra stocks lag, while it's the FMCG and auto which trade higher. Mid-caps are outperforming. We'll talk about the market fundamentals with Swati Kulkarni of UTI Mutual Fund.
Triveni Turbine is surging in trade on the back of a big block deal in a CNBC-TV18 exclusive. The management confirms that Triveni Engineering has sold its entire 21.85% stake in Triveni Turbines. Details coming up for you in just a bit.
SpiceJet is under pressure as the company undertakes new cost-cutting measures. More details coming up in just a bit.
As demand concerns rise for the IT sector, we get you an analysis of what companies have to say on the FY23 outlook and how IT budgets are shaping up for the full year. A complete explainer on our brand new series coming up on the show.
And we'll also track the banking sector demand and outlook with Saurabh Kumar, Executive Director of India Banks and Financials Research at JP Morgan, from the sidelines of the JP Morgan India Investors Summit. All this and much more lined up over the next 60 minutes.
Let's start then with the big story on top of trading. Our Triveni Turbines is up more than 3% as 21.8% equity changes hand. Vivek is here with the details. Vivek.
Well, that's right. Like we've been highlighting, both of the stocks have been in action for the past couple of trading sessions. In fact, both Triveni Engineering and Triveni Turbine have perked up in today's trading session. Remember, Triveni Engineering at the end of the June quarter actually held 21.85% stake in Triveni Turbines, and as per our sources, we had told you earlier that they were looking to completely exit this particular stake. This particular CNBC-TV18 newsbreak was confirmed. Out of the 21.85% stake, 10% stake was bought by the promoters of Triveni Turbine, and another 11.85% stake, the management actually came and told us that it's been bought by a set of very marquee investors, including sovereign wealth funds from the Middle East and also California-based funds, along with some large domestic mutual funds. It's very interesting development. Along with that, we also understand that going forward, this entire promoter family would be split into two, and Triveni Engineering and Triveni Turbines would be looked at by the two brothers. It's a very interesting corporate development. We expect more interstate transfers and interstate promoter shareholding transfers going forward, and both of these stocks will continue to remain in focus.
All right, Vivek, thanks a lot for bringing us all of the details. In fact, we spoke with Nikhil Sawhney, who's VC and MD of Triveni Turbines, and he confirmed to us that promoters have also bought stake in this block deal. So let's listen in.
We're very proud that we have, and I believe very marquee investors, many sovereign wealth funds and large international institutional investors, as well as very large mutual funds. And I think that we have, I believe, extremely quality investors. This was, of course, as you alluded to, a divestiture from the engineering side, where they've sold 21.8%, I think, for approximately 1,600 crores. And we at Triveni Turbine are extremely proud of the fact that we've been able to actually expand the float of the stock, as well as the promoters itself have also bought 10% of that block. The ultimate plan, as I am the Vice Chairman and Managing Director of Triveni Turbine, and my brother is the Vice Chairman and Managing Director of Triveni Engineering, it would be for majority shareholding to reside with the operational executives of that business from a family perspective. As you rightly pointed out, the principal promoters are my father, my brother, and myself. And as my father's plans his succession, it will logically fall to the sibling that is operationally in charge of that business.
Okay, the next stock in focus is SpiceJet. The stock is under pressure because of their recent cost-cutting measures which have been announced. Sonia is here with all the details. Sonia.
Well, thanks a lot for that. You know, SpiceJet has been under a lot of pressure because the company is going through a severe balance sheet crisis. We've been reporting this for the last several months, and the latest is that 80 pilots have been put on a leave without pay for the next 3 months. Now, the management does say that this is in order to bring down costs. Remember, the company was looking to raise funds for the last many days, but on the recapitalization front, nothing has fructified. If you look at the trajectory for SpiceJet, right, in the last 5 years, the losses have steepened significantly. In FY22 itself, SpiceJet saw a loss of around 1,722 crores in the full year. And there have been problems galore for SpiceJet. You had the CFO resigning a while back. It was the second straight month of delaying payments to its employees. The auditors said that there are some concerns that SpiceJet may not be able to go forth without raising funds. On that effect, the management has several times said that, yes, the fundraising plan is in action, but nothing has fructified so far. And the latest piece of news that 80 pilots have been given a leave without pay for 3 months just goes to show that the balance sheet problems are still underway. Also, other issues, like the safety concerns as well as the deregistration of some of their aircrafts by the DGCA has plagued the operational performance of the company as well. All in all, more disappointing news coming in for SpiceJet.
Sonia, do stay on because you're also looking at M&M, and there the news is that they have proposed to buy an additional 17.4% stake in Swaraj Engines from Kirloskar Industries. What does this mean for all these three companies? They're all listed. Tell us more.
So let me start with Swaraj Engines, right? Because that's the stock that's moving quite a bit. It's up 12% right now. It's hit a 52-week high. As you rightly pointed out, M&M already owns stake in Swaraj Engines, but now it has bought an additional 17.4% stake from Kirloskar Industries for 296 crores. Now, with this, Swaraj Engines becomes a subsidiary of M&M. And hence, M&M gets complete control of Swaraj Engines, which is a big positive for the company. In any case, Swaraj Engines, as we know, was supplying engines to the farm equipment business for M&M, so for the tractors. And the company has done very well in the past. In fact, the revenues were up 15% just in FY22. And the last 3 years, the revenues for the company have improved substantially. Now that M&M will have complete control over the management, etc., it is a big positive for Swaraj Engines. Let's move on to Kirloskar Industries. Now, Kirloskar Industries is the holding company of the Kirloskar Group. They will get 296 crores for selling the 14.7% stake to M&M, and they'll get about 300 crores on a market cap of 1,600 crores. There's also a holding company discount that Kirloskar Industries is trading with. So that's the reason why that stock is up. Now, for M&M has been making all the right noises as far as consolidating their business is concerned. Their focus is on the core business, both auto as well as the farm equipment space, and they're looking to get rid of all their legacy businesses, even unlock more value for shareholders. Now, with this increase in Swaraj Engines stake, it gives M&M more control over the management. They have focused on growing the farm equipment business, not just on the top line, but reinventing the cost structure as well. In the quarter gone by, as per the latest data, they've gained about 1% market share in the farm equipment business. They had the highest domestic volumes of 112,000 units in quarter one, and the volumes itself went up about 18% on a year-on-year basis. Also, M&M is very hopeful about a 7 to 8% compounded growth for the tractor industry over the next 7 years, and they're taking all the right steps in order to not just grow the top line, but also come out with an efficient cost structure. Hence, it's a win-win for all three companies that are, in focus today.
All right, Sonia, thanks a lot for taking us through that entire explainer. Win-win for all three companies. Swaraj is up around 12%, and you also have Kirloskar, which is up around 8%. But with that, we're going to get into a short break now. When we come back, we'll shift focus and talk about what's going on in the world of commodities with Manisha Gupta. Welcome back. You're still tuned into Trading Hour for the market. It is quite flat right now, just around 10 points lower on the Nifty. The mid-cap index is faring a little bit better. So that is around 0.2% in the green. And remember, like we were telling you, this is at a time when all of the Asian markets are seeing pretty sharp cuts. So the Hang Seng index will come up for you. That one is significantly lower right now, over 1% in the red. It's 1.3% lower. You have Nikkei, which is trading with sharp losses, 340 points in the red. And in that context, our markets are definitely looking quite resilient and holding up, but it is the banks which are taking a little bit of a breather. So the likes of IndusInd, Kotak Mahindra Bank seeing some cuts. But as promised, let's talk about the commodity space now. And Manisha Gupta joins us to tell us what's going on in the world of metals. Manisha.
Thank you for that, Pavitra. Well, ahead of the US Fed meeting, we have seen pressure continue in case of the metal prices there. So whether it's industrial metals, precious metal prices, all of that has been trading in the weakness. And then you are expecting a 75 basis point of a rate hike. And because of that, the US dollar index has been surging higher, holding around that 110 mark, which is a 20-year high. For metals, it was also about the global industrial activity, which has continued to slow down for many months now, especially in China because of the zero COVID policy there. We have seen all economic data come in on the weaker side. The US Fed interest rate hike is one that is awaited, is going to be the biggest event for this month and this week for sure. But apart from that, you also have had Sweden, which has increased interest rates by 100 basis points. There also is a big string of central banks meeting in this week itself. You have Bank of England, you have Japan, Switzerland, Norway, all of these monetary policy meetings also happening in this week, and the markets are anticipating action from these global central banks also. So when you look at the gold prices, we have seen a 29-month lows on that. Silver prices, after declining 2% overnight, have continued to see a further decline here. Gold prices actually are down by nearly 3.5% already for the current month here. That's about the precious metals. If you look at the base metal prices, they are trading in the red as well. The copper prices, with even a 0.25% of gain, are still near 2-week lows until they trade below 650 rupees per kg there. For copper, essentially, the ground demand also seems to be declining. The inventories have continued to increase on LME, and by the end of August on LME, we did see the material earmarked for delivery at near 50%. That has seen a decline up to nearly 11%. So that means that on-ground demand seems to be receding there. Not just copper, if you look at zinc, aluminum, nickel, all of these metals have continued to decline. Aluminum, for one, is trading at a 17-month lows. Zinc as well is trading at a 2-month lows right now. For zinc, the Chinese demand has seen a very sharp decline for the month of August. We are looking at zinc inventories increasing in China. That seems to be weighing onto that market. And even as Europe has cut off capacity by nearly 50% for a couple of metals like aluminum and zinc. So the supplies are not available, but it is the demand that also seems to be declining, is the reason that the prices have continued to decline here. As I said, it is going to be China on whether or not they come out with a stimulus. What are their COVID restrictions going forward? forward is where the markets will take cues from. But as of now, all eyes on US Fed. And ahead of that, this week has seen a decline. So nearly 2 to 3% of a cut is what we are seeing in case of gold and silver prices on a week-on-week basis. As I said, silver prices have declined by 2%, so 2.5% down for the week now. It's the same scenario for the industrial metals as well, with the biggest of declines coming in for iron ore. That one is down by 6%, but otherwise as well, 0.5% to 2% of a decline across metals on your screens.
Manisha, thank you very much for that. Let's now turn our attention to the banking sector. The banking sector has seen the biggest re-rating in the last 3 months. Compared to the other sectoral indices, the Nifty Bank has recovered 25% just in the last 3 months. The Nifty Bank was at a level below 33,000 3 months back, and now it's very close to its 52-week high. We've seen an improvement in India's macro. There has been some, multiple re-rating. The credit growth demand has also been very strong. The latest one shows that the credit growth stands at 15.5%. From the sidelines of the JP Morgan India Investor Summit, we're now joined by Saurabh Kumar, the Executive Director of Banks and Financials Research at JP Morgan. Thank you very much for joining in, Saurabh. First, if you could tell us, have you had any conversations with banks, the financial institutions, and what has been the biggest takeaway from you from this conference now?
So thank you for inviting me. I think the biggest takeaway is essentially on growth, that we are seeing, as you rightly pointed out, credit growth has gone up to 15.5%. And there is actually upside surprise coming in. So hopefully we look to a very good festive coming through in October. But the broad takeaway is that the growth estimates probably could be revised upwards for the system. On the more negative side, I think the concern is essentially that the deposit growth is still weak. So to fund the credit growth, effectively, maybe there will be rate hikes which will come through on the deposit side, and that could then start to pressure NIMs maybe next year onwards. So near-term NIMs go up, but on a more medium-term basis, NIMs could come down. But I think the positive is essentially on the credit growth piece.
Why is it that deposit growth has been weak?
So, one is obviously that effectively the deposit rates are, because of the policy action by RBI over the last 2 years, have kind of come off. So savers have moved to alternate investments. So we have seen some piece of that play out in the at least on the retail deposit piece. So that's one. Secondly, the credit creation before that was also weaker. So that has a lag on deposit growth, which is what we are seeing. Hopefully with the lag as credit growth picks up, even the deposit growth will also start picking up.
Right. Hi, Saurabh. Good morning. So you were just saying that, the net interest margin might go up in the near term, but in the medium term, we could see a little bit of a hit. Could you tell us how much of a hit you're factoring in on the margin?
So if you look at the banks, the incremental credit deposit ratio, especially for private sector banks, has started to get stretched. It's well above 100% for almost all of them. And also the private banks have used excess liquidity on their balance sheets. So by next year, we would imagine a 10 to 15 basis points compression could happen. But for every bank, the number is different. It's not uniform across all.
What was the takeaway from the banks when it comes to the asset quality? Because the 2-year window for restructuring will come to an end. How much of it can slip into NPAs? What has been the feedback on asset quality? Can you talk a little bit more on that?
So on asset quality, what's very clear is that the credit provisionings have normalized. In fact, they could go to below normalized levels because the corporate asset quality picture is very, very strong. So we will see probably below normalized provisions essentially happening because a large piece of the system, which is the corporate sector, is very clean at this point of time. There will be slippages from the restructured book, but we have to, if you look at most banks are also sitting, at least the private sector are sitting on excess provisions. So there is in some sense, buffer to draw down on. So the net impact hit to the earnings, so the P&L will not be very high. So the absolute credit provisions, depending again on the bank, should be 1% or below, at least for the private sector, and even for the public sector, we should see a very sharp normalization downwards.
Saurabh, we have been discussing, the retail loan growth. How much do you expect this to go up? Of course, we are in a rising interest rate cycle, but we also do have the festive season, which is, pretty much around the corner. So how do you see retail loan panning out for the rest of the year?
So if we look at the retail piece, we would expect a slightly higher growth, which is about 16% because if you look at the biggest exposure of the retail sector is essentially into mortgages, where the property cycle after a very long downturn is starting to pick up. And that is where, even as a house view, we are very constructive on the cycle pickup, at least on the mortgage side. And that is where we think the cycle can sustain. It can actually run at 16-17% for a much longer period of time now.
You know, up until now, Saurabh, the credit growth for banks has been driven by working capital requirement. We haven't seen a broad-based pickup in capex. What is the feedback that you're getting from banks, and what could be the extent of the upside surprise to credit growth? What are your own numbers at?
So yes, there is hope that the capex will pick up. The conditions have fallen into place, but we have to recognize that the macro, there are some challenges as well. But at least what we are hearing is that most of the corporates have at least started making the announcements. From announcement to drawdown, there will be a lag. It may not happen immediately. Hopefully, this will be a next year situation. But we should certainly see the large industry credit growth, which is running at roughly 3% hopefully should move to about 8 to 10% odd levels by next year.
So
that will basically aid the credit demand upwards.
Okay, so what is your credit growth forecast for this year and next year?
So this year we are at 14% for the system. Next year we are at about 16%.
And this includes the 16% forecast for next year includes a pickup in capex?
A modest increase in capex, yes.
Saurabh, just one final question before we let you go. You know, within this space, which are you more sort of positive on the PSU space, on the private banks? And also if you could just run us through some of your top calls in the banking space.
Yeah, so what we are seeing on the system is essentially the constraint is just shifting from asset quality to liquidity, which is deposits. And if you look at public sector banks, they are deposit rich. So in some sense, the PSU banks do look very good as investment opportunities, but will be very selective within that space. So as of now, our top picks are Bank of Baroda in the PSU space. We have Bandhan and ICICI Bank. And in the NBFCs, we have Bajaj Finance.
What is your view on, if NBFCs will get to issue credit cards? There's been a lot of back and forth on it in media.
So it's unlikely. We'll have to see what the Reserve Bank eventually decides. But at this point, it does not look something which is very immediate to us.
Okay, not very imminent. Saurabh, thank you very much for joining in, and have a lovely conference. Thank you for joining us. Get into a break on that note. We'll come back and discuss market technicals. Mitesh Thakkar joins us next. Welcome back. KPIT Tech is the company which is on our radar. The company has made an acquisition of an automotive prototyping and products company called Technica Engineering. It's an EU-based company, and KPIT Technology will be spending a total of 80 million euros, which now, at the euro-dollar parity, turns out to be $80 million as well. The consideration will be paid over the next 6 months, and moreover, a maximum of 30 million euros will be paid as earnouts over the next 2.5 months. Now, the acquired company had revenues of about 43 million euros with an EBITDA margin range of 20%. This, according to analysts, should roughly add about 10 to 11% to KPIT Technologies' annual revenues, and the company has said this acquisition will be EPS accretive from day one. The cash in the books is sufficient for KPIT Tech. They had close to about 1,060 crore as of Q1, and they've said this acquisition will be funded via cash. The acquisition will be completed in October, which means the company will have 5 months from November to March to consolidate the revenues from the acquired company into KPIT Tech. So clearly, there is going to be a boost to KPIT Technologies revenues as well as margins. So the question is how much, do they manage to increase the full year guidance? The FY23 KPIT guidance given by the company was about 18 to 21% in top line with margins of 18 to 19%. So that's KPIT Tech for you. The stock is up close to about 1%.
All right, Rima, thanks a lot for taking us through all of the details on KPIT Tech. But let's quickly take a look at the market because there has been a slip that's come through in the past few minutes. We're currently around 45 points lower, so around 0.25% lower on the Nifty index. In fact, the mid-caps which were holding up, and they were looking a lot better than the frontliners as well. That index has also moved into the red. So it's a good time to get you a technical check on the market. Mitesh Thakkar joins us for exactly that. Mitesh, good morning. Thanks for joining us. So currently, we're seeing around a 40-point cut. In the past 20 minutes or so, there has been this dip which has come through. How do you look at it today? And would you take a call on the index level ahead of such a big decision by the Fed?
Yeah, I think the index, fortunately isn't giving you directional bias. It's basically still 17,860 to about 17,500 kind of a range. So on the index, we are somewhere in the middle of the range, not trading the index for the timing. But I think on stock-specific basis, we are slightly net long, given the fact that a lot of stocks are giving breakouts. But we also have explored some put option positions in individual stocks.
Okay, Mitesh, what are the stocks you're looking to trade today?
Yeah, I have a buy on Britannia. I see that's a stock again, which is breaking out nicely with price and volume action on the upside. Keep a stop at about levels of 37.30 here and a target of around 3900 is what traders can look at. Sorry. Well, the other stock is a sell on DLF. That's a stock which is giving a pullback. So could correct it slightly from these levels. That's a sell with a stop at about levels of 390 for targets of around 372.
All right, Britannia and DLF. Mitesh, thanks a lot for that. In fact, Britannia is the top gainer on the Nifty as well right now, seeing a move of around 3.5%. But with that, we're going to get into a short break now. You don't go anywhere. When we come back, we'll discuss the market fundamentals. Swati Kulkarni of UTI Mutual Fund will join us.
Hi, welcome back. Let's shift the focus now to our brand new IT series. As demand concerns rise for the IT sector, what do companies have to say on the FY23 outlook and the IT budgets shaping up for the year? Rima is standing by on the big wall. Rima, the first company on your radar is Infosys. So the stock is hovering very close to its 52-week low. What is the management telling analysts?
Thanks so much for that. So the first takeaway is that Infosys management is maintaining its outlook despite the macro concerns. So the FY23 revenue guidance stays pat at 14 to 16% in constant currency terms, while margins will be at the lower end of 21 to 23% range, something that the management had guided in July itself. So it's a status quo when it comes to the FY23 guidance. Now let's move on to the demand environment, which is where there are a lot of concerns given the fears of recession in US and Europe. The key takeaway from the Infosys management is that they've highlighted some weakness in two segments. One of them is the mortgage business due to rising interest rates, and secondly, in the retail vertical due to high global inflation. Again, remember, this should not come as a surprise. In the Q1 conference call, Salil Parekh had said, and I quote over here, we do see pockets of weakness, for example, in the area of mortgage, in the financial services. We keep a close watch on the evolving macro environment in terms of the changes to the pipeline. CFO Nilanjan Roy also echoed the same thing, and he said in the conference call, we are seeing some slowness in the mortgage industry and the lending business due to increased interest rates. We remain watchful of the impact of emerging global developments on budgets for clients. Despite these cautionary statements made by the management in Q1 as well as in the recent conferences, the management continues to reiterate the demand and the deal pipeline has not been impacted. They say that growth remains broad-based with the pipeline for large deals higher than what it was a couple of months ago. Where they have highlighted some concerns is there is some slowness which is there in the decision-making cycle at certain specific clients, and certain clients are looking at cost takeout projects to now fund their digital and cloud initiatives. But the long-term picture still continues to be very intact. The worry is what happens to the demand. Today it's intact, but what about next year onwards? Is there a risk to next year's tech budget? Here, let me pick out an extract from a CLSA note which said that macro risk could pose challenges to clients' calendar year 23 IT budgets, but the process is yet to start. Conversations with clients thus far have indicated that they're unlikely to reverse their long-term digital investment plans in a recessionary environment, though the pace could slacken. So there is some caution which is emerging on that front. Now let's move on and talk about the picture on margins and the supply side. Well, Infosys, as I started off saying, said that they're holding on to their margin guidance. What they've also said is that there are sufficient levers for margins to improve from the lows that it had in Q1 FY23, which is 20.1%. They said discussions are still going on for higher pricing and attrition has moderated, but still remains very high. Back to you.
All right, Rima, thanks a lot for taking us through all of those details on Infosys in this brand new series that we're tracking. The market, by the way, is slipping a little bit further. You have the Nifty Bank, which is seeing the losses widen, so it's around 190 points lower on the Nifty Bank, and you have some from the metal pack also, which have seen quite a lot of a cut. So let's do one thing. We'll discuss the markets right now and all of the sectors that you can bet on. Swati Kulkarni, Executive Vice President and Fund Manager at UTI Mutual Fund, joins us now. Swati, in fact, Sumaira, you were telling us this manages India's oldest equity fund.
Yeah, that's right. The UTI Master Share Unit Scheme, and that has a vintage of 35 years. So they've seen many, many business cycles. Swati, thanks very much for joining in. It's a large cap fund, right? And the performance has also been quite good. But Swati, the issue now with large caps is, and currently given the volatility, all portfolios are large cap oriented, right? I mean, even a lot of these individual names have large cap oriented portfolios. But this concern around shrinking alpha is just not going away from the large cap space. So what is the outlook for your own fund? And do you think that over the next, few years, the investor who's investing currently in these active large cap funds is going to increasingly try to move towards an index fund? I mean, what is holding investors' fancy in an active large cap fund today?
Yeah, thanks, Sumaira, for having me here today. Actually, you're right. In the current scenario, what you said is reflected that the alpha is not there. Probably we are lagging index. The best performing fund also is lagging index by a few basis points. But if you see the long-term performance of the large cap funds versus the index, definitely there has been a case where the alpha has been generated. There could be various reasons why in a short period of time the alpha may not be visible. One is, of course, that the strategy or the investment philosophy that a fund manager follows may not, certain stocks or businesses may not fit in. For example, in our case, the low ROC businesses or the businesses which are more managed as a diversified structure rather than, appointed a direct exposure. We have actually preferred to have direct exposure to those businesses which we like in terms of their long growth runway or in terms of the, the pricing normalization that could happen. So we have preferred those kind of businesses. Probably, I think in long run, these businesses are likely to do better and a much improving ROCs is what we can expect. So it is in short term, it is very well possible that certain stocks may not fit into the strategy and you may lag. But as I said, there is a case for actively managed funds. I would also say from an investor's choice perspective, passive will also be, competing. They will compete with the actively managed funds. And passive really makes sense for one's portfolio when they have a view on the market and, they don't want any fund manager related choice of stocks in that short period of time. Probably passive does have a say. And on our part, like UTI Mutual Fund has been introducing various smart beta passive strategies as well, which could, tap this demand which is there from the investors for passive funds as well. So I think both will coexist, and long-term alpha creation opportunities have been there. MasterShare has proven that in the long term. As you said, this fund is in 36th year of its management. And if you see since inception, the returns have been 10 lakhs invested is about 18 crores and versus benchmark of about 12 crores. So there is a 6 crores extra alpha absolute amount generated over these many years. So a small increase in terms of, or small alpha over many years actually works wonders, and it can actually, the compounding effect itself can show a much higher wealth.
All right, Swati, that point is taken. You know, I was taking a look at some of your big holdings, and a lot of them are financials. In fact, I think financials contribute around 34% of your total as well. Do you think this is still, you know, if someone is putting fresh money into the market, do you think at these levels also the financials still look good? Because we have seen quite a run up already.
Yeah, so first of all, it's a portfolio. So, you know, when I give my view on financials, it's not a sector, you know, that it is not a solicitation for a sector related investments from an investor's point of view. But from a portfolio perspective, financials does make a sense at this point of time, because, you know, if you see the balance sheets have been much more cleaner. The NPA ratios were hovering around 6% in 2018. Now they are down to about 2%. And our preference has been to low-cost, low-cost funds, banks which have strong capital adequacy. And we think that these are well positioned to capture the credit growth. And valuations, if you consider the, the growth opportunities and the rising return on assets that these banks are likely to report, valuations are not that high as well. So our preference has been there for such companies.
Swati, where do you stand in the entire IT sector? Never before has the street been so divided about the prospects of IT. You have clear bulls and you've got clear bears. And, you know, everyone's not convinced that the recovery in margins is going to be substantial in the next, 2 years or so. And valuations can get back to the levels where they were. Your thoughts on IT as things stand currently?
Yeah, so Rima, I would say that we were in the bulls camp as early as from 2017 onwards, and the fund got benefit out of it. But I think somewhere during last 1 year, in fact, the possibility of this sector facing slowdown challenges in terms of the clients facing or postponing the demand, we have turned more of a neutralish, and we are neutral because if you look at the characteristic of this sector, whether it in terms of the high return on capital employed or in terms of the cash flow generation, we really like that. And valuations have corrected from the peak, that what we have been discussing, the margin pressures perhaps are behind us. The attrition has been coming down, though still it remains high. I would say that companies do have margin levers. There could be options for some pricing arrangements, and then there are some company-specific things that in past their costs have been higher, and as they ramp up the large deals, and the revenues also start to flow in a higher proportion, you could see margin tailwind coming from those also. So I would say that IT, we are neutral at this point of time, but yeah, we are probably, hoping that the digitization or the need for, moving data on cloud and we having top-notch user experiences is universal. And there is a structural need of technology to be imbibed by many clients, and therefore it could be at best postponement of demand and not necessarily loss of demand.
Postponement of demand and not loss of demand. That's what is currently besieging the Indian IT space. Swati, thank you very much for joining in. Need to get you now a CNBC-TV18 exclusive. JP Morgan Chase Chairman and CEO Jamie Dimon talks about India's entry into global bond indices, says a bond index inclusion is a sign that India's economy is growing and getting bigger. He also tells Shireen Pan that India could be a huge beneficiary of China Plus One strategy. Listen in.
Absolutely, you should ask me, you should fight for it. And I can't get involved in that because research is independent. So by law, but if I was India, I absolutely want to be part of it. And if I didn't get in, I'd ask why. And then I try to accomplish those things, get in. And so I'm hopeful for you. And, it is a sign of a country, coming, growing and becoming bigger and better well known. And once in indexes, the other thing it does for you, it's always out there. So you get a lot of foreign direct equity investment. This one you get also foreign direct credit investment. And, you have people like America who want to be your ally and partner in many more ways. And then I think you have a little bit of a gift. This is not, what I'm about to say is not anti-Chinese, but as every nation looks at, and every company looks at supply chains, they're going to have to diversify more. And a lot of people say China isn't as secure a supply chain and therefore have to move manufacturing to somewhere. And I think India could be a huge beneficiary of that. You got to make sure the rules are right, the regulations are right, the capital is treated right. And I talk about rules and regulations, I talk about rule of law, bankruptcy law, tax code. If you get those things right,
Welcome back. So in today's Global Spotlight, we're talking about how U.S. companies have started to paint a grimmer picture of the U.S. economy. Now, a whole host of companies across industries like auto, delivery giants, steel companies, and even retailers have issued warnings in the last 1 month, citing high inflation and a bleak demand globally. And this has raised a worry that the U.S. may not be able to avoid a hard landing. It also perhaps gives you an indication of what is coming in terms of the earnings season, and that may not be so rosy. Now let's start with Ford Motors, the shares which suffered its worst fall in more than 11 years yesterday with a decline of 12% after the automaker pre-released part of its third quarter earnings report and warned of a whopping $1 billion in unexpected supply costs. And they also pushed forward their deliveries into the next quarter. $1 billion of a hit on account of inflation as well as shortage. This announcement also caught several people off guard as expectations were that the supply chain problems for the automakers, the shortages were actually easing. Ford's warnings, remember, comes less than a week after delivery company FedEx dropped the ball as earnings missed estimates and the company pulled or withdrew its annual guidance due to slowing global demand. FedEx cited macroeconomic weakness in Asia, service challenges in Europe, and Ford and FedEx announcement together have only added to the growing gloom from companies across industries. General Electric, GE's CFO, had warned that the company is seeing pressure on cash flows amid supply chain snags, while industrial titans like US Steel Corp, Alcoa, Nucor, all of them have said that deliveries are waning. The chief executive officer of McDonald's Corp had said that he expects a minor U.S. recession in 2023 and a more significant one in Europe. Even retailers in the U.S., big ones like Walmart and Target, had reported a very large stockpiles of unsold inventory. And this is just all growing evidence that the U.S. economy is perhaps slowing and a soft landing may almost seem impossible. These downbeat corporate updates from big businesses have also added to market worries that this may just be one of the many. We're going to see a lot many more in the coming few days, and there could be margin compression and some softening in the top line for companies of large U.S. companies when they report their earnings in October. In fact, analysts say that this could be the perfect opportunity to throw the baby out with the bathwater and get the opportunity to use all the negative information out on your balance sheet. But markets are going to watch what impact this has on corporate balance sheets. If companies are actually getting hit on account of $1 billion, will this start reflecting in terms of a hiring slowdown, some layoffs, spending cuts? This is going to be watched very closely. But the bottom line, that we wanted to highlight is now increasingly across sectors, large U.S. enterprises are warning of hits to their profitability on account of inflation as well as slowing global demand. On that note, we'll get into a very short break. We'll come back with more on the markets on the other side. Stay tuned.
Hi, welcome back. Here with Trading Hour. The Prime Minister has launched the National Logistics Policy, which sought a unified, holistic approach to logistics in terms of policy, regulation, and an overarching common institutional framework. Following this, my colleague Abhimanyu Sharma caught up with the DPIIT Secretary Anurag Jain to discuss the policy workings and began by asking him the difference the policy will make on the ground.
As of now, people estimate that the logistic cost in this country is about 13 to 14%, and the global benchmark is around 8 to 9%. In the policy, we have kept a target for ourselves that by 2030 we should be meeting the global benchmarks. Now with National Logistic Policy, a lot of innovative tools have been brought in. A logistic operator needs to actually interact with 30 systems across 7 ministries.
How does the policy intend to integrate and benefit small businesses, transporters and other members of the lower end of the logistics spectrum who are often hamstrung by lack of technical know-how and probably later or limited access to newer announcements by the government?
As I just mentioned, ULIP is a platform. On this platform, the startup ecosystem has already started acting. There are so many companies which have already started building application layers on top of this platform, which is directly helping the people at the other end. I am sure that these application softwares, developer companies understand the psyche of their clientele. They make their products in local languages. They make their products voice enabled. So therefore the adoption of technology, like when we started with UPI, many people were very apprehensive that in the rural areas the adoption will not be there. It will be very difficult for rural areas to come over it. But you see what has happened.
All right, that is the word coming in from the DPIIT Secretary. With that, we're completely out of time on this edition of Trading Hour. The market is slipping. It is currently around an over 100-point cut that we're seeing on the Nifty, and the Nifty Bank is down more than 400 points. The likes of Indocin, Kotak weighing pretty sharply. It is only the FMCG index which is holding in the green. Even the autos have taken a sharp knock. So stay tuned. Halftime report comes up next, and we're going to take all of this market action forward.